which will mean silver will be even higher than our target at 333, our localized high target. We see single digits. At the moment, you're still in that phase where you've had a reversal against a very steep move to the downside. Many markets, they never go up in straight terms. Silver is looking absolutely beautiful in the not too distant future for breaking out of a falling wedge. I don't think it will be easy for it to get into the 50s, and if it did, it would be the 58s to the 59s type range. The real engine is what gold does next as the king of the market. Gold is in a continuation pattern as well, but it's not a falling wedge, more slightly broadening structure like this. And again, you've had a big sell. Hyper stagflation will be hyper powerful for gold, and that's what they've ordered up economically for us. A throttling of goods, an increase in the cost of living, and debasement of fiat and debt. You're right about getting into the 40s on the low. We went as low as 43 gold silver ratio, and now you're sitting at 64. And that's where you had what happened in silver recently, that you were at 120, 121 plus going for 122s, and then next moment, you trade 64, which is almost 45+% in rebase. Now, any leverage gets forced into selling, and that exaggerates, and it creates a bigger headline. They can now say, crash, the high, it's over, the bull market's over, they can create more news. So sometimes the force that drives something higher is not your friend if it's a short-term force that causes an over-acceleration and a high peak kind of blow-off. But many markets, they never go up in straight terms. Silver is looking absolutely beautiful in the not too distant future for breaking out of a falling wedge. So I'll just share that chart with you because, it would be remiss not to. And I think you'll see that's what I mean by that when I do that. Here we go. This is where we are on silver. And let's just get rid of a couple of things. A nice clean draw for you. That's a falling wedge. And we have 3 impulses. There is a possibility it could happen that you're going to have one more sell-off. So essentially the structure looks like that. And you're going up.
Silver's 45% plunge from $121 to $64 exposes the hidden fragility behind headline surges. As Francis Hunt points out here, leverage can exaggerate these moves, creating artificial panic that misleads everyday investors. Short-term blow-offs often signal more structural strength than weakness, especially when a falling wedge is forming, indicating potential upside continuation. This isn't a straight climb. Markets rarely are, but technical patterns suggest silver could resume its upward trajectory once the forced selling eases. Next, Francis Hunt discusses how one final sell-off might actually set the stage for a significant breakout.
You could sell off one more time to the downside. It's not entirely clear that that has to happen. You might have made your third impulse. We talk about 3 impulses in falling wedge. So you might have had it already there, but it might go a little bit bigger one more time. So you could up and over one more time. But if you break this red line that I've drawn, which I'll just double up now, that is the capping, descending grind line that is part and parcel of a rising wedge. You've got an interaction there, and now here. That's this level breaks, it's all moves to the upside. So the minute you see this going here, or if it continued just to march out and break here, you're going to see a lot more from silver to the high side.
That other fall, it's looking like it's down in the 50s. Could possibly get down there.
I don't think it will be easy for it to get into the 50s, and if it did, it would be the 58s to the 59s type range. So the interesting point I will make is silver took its worst hit in the first hit, and it was far more. You can see the gradient has flattened there, and also the amount. You're at 121, and then you went 64. So, it's almost $60 minus 3. That's $57 that you dropped there. From here, you drop from 96 to 61. So that's 34. So you've gone from 57 in the sell-off from the localized high to around 35. It's 35 actually, a little bit more than 34. There's a couple of cents in there. So that's the 35. And each time you've rallied, now the question is, will you have one more leg down here and get into the upper 50s? That would be a wow, invest all you have moment as far as I'm concerned. There's another smaller version of a falling wedge. And as I highlight, these are typically continuation patterns in upsides. You can see that the three little impulses, very small final impulse in the end, but you can see how well it moved. There's a little upside HVF. These are all continuation patterns all the way up. This is a macro continuation pattern, and you could find that silver spits up to the 109s and 10s in quite short succession once this breaks. But beware, you might get one more down leg. You could break from here. The market will determine, and it may hang off gold a little bit, because the one thing I sometimes say is silver's kind of like the trailer with a bungee cord on the back of the 4x4.
Investors often fixate on immediate drops without seeing the pattern beneath. As Francis Hunt points out here, silver's 3-impulse structure and a falling wedge suggests any further dip into the high 50s could be a prime buying opportunity rather than a sign of weakness. The gradient has flattened after prior steep drops, indicating selling pressure may be exhausted. Technical continuity signals that once key resistance is broken, silver could accelerate sharply, despite short-term volatility. Next, Francis Hunt shows how the market could respond if this final down leg materializes.
The real engine is what gold does next as the king of the market. And gold is in a continuation pattern as well, but it's not a falling wedge. It's more slightly broadening structure like this. And again, you've had a big sell. The gold's second sell was even larger by amounts. This was $1,300. You went from over 5.4 to below, right down to the 4,098 here. So that was a bigger sell than the initial one. So gold was more rattled the second time, but it has also re-climbed a lot further. It's had a little shooting star. That's what this candle is called at our splitter, but it's done the perfect way of negating that. It traded down and now has gone and done a hammer all the way back. So it kind of neutralized that. We're already halfway. The problem with this is gold only confirms when it breaks this level, the capping descending grind line up top here. That's quite a bit further away. You could have to sit out and watch it go quite a bit higher before that happens. And then there's often a return move. So you could buy in, get moved up, and then still get a move that takes you back down.
Gold's volatility hides its underlying strength, and many investors miss the real signal in these swings. As Francis Hunt points out here, the $1,300 sell-off down to $4,098 was technically larger than the first, yet gold quickly neutralized losses with a hammer candle, showing resilience. Continuation patterns indicate upside remains intact, though the capping descending grind line is a critical barrier for confirmation. Return moves could shake short-term confidence, but they don't negate structural bullishness. Next, Francis Hunt discusses how this broader pattern sets the stage for sustained gold strength.
And you don't know if that return move will occur before it continues to the upside. But these are all big continuations. There was another time we had a broadening, and we were on your channel and we discussed this. People will forget it, but I'll just remind them when that occurred. And it was a much bigger one by time. And it was flat across the top, unlike this one, which has a downward descent, but it was a broadening structure nonetheless. And it was also a descending splitter. That's that middle line on a bull pole. So that was your pole. So we called for upside break, and you may recall we called for the 3,000 level to be run when you were at 2,000 on this tiny little fractal squeeze that was sitting on the 2,000 level, because that flat top saw each wick just beat the 2,000 level. We talk about key levels just run. That runs you through to 2K. And then you had this little squeeze up, and that set you on a journey that sees you sitting and trading 5,600 at one point, all the way up from 2,000. So that was a $3,600 move that came out of that. Listen, we went sideways for long enough. It was 2020, before 2021. So we went sideways for 2021, 2022, a large part of 23, and then this detonated early 24. So it was 3 years in the making. That took a lot of patience. But when it came big, and it gave $3,600 on top of the 2,000. So that's a broadening structure. Now, this one is not nearly as lengthy. So it will end sooner, and that's good news broadly. But there's still a chance that there's a third sell-off in this.
Last year, platinum, it moved pretty similar with silver, percentage-wise, where we saw the gains on platinum as well. How's platinum looking relative to silver and gold with the charts you were just showing?
Yes, let's have a look at platinum. So platinum is very similar to silver in terms of its technical setup. And because of the industrial component, it tends to mimic, it's kind of a hybrid of both, but often more so the silver market, because it does have that industrial element to it.
The broadening patterns of gold and platinum reveal the patience required to capture meaningful gains. As Francis Hunt points out here, the multi-year build from $2,000 to $5,600 shows that sideways periods aren't stagnation, they're accumulation phases priming for explosive moves. Platinum's correlation to silver adds another layer, blending industrial demand with speculative momentum, which most investors overlook. Short-term pullbacks may appear threatening, but structurally, these metals are setting up for higher highs. Next, Francis Hunt shows why watching these interlinked metals provides a clearer picture of macro trends than headlines suggest.
But if you're looking at this technically, this is again, you can see when you've plunged, you've been bought up. Those wicks bought up. That was a big hammer, bought up there. Bought up when you came down there. Bought up when you came down here. Another big hammer. And again, across the top, quite sharp suppression down across the top. So you've got a very steep descent across your capping descending grind line on that wedge. So there's a break, there could be a breakout not far out for platinum, or you go up to the line and you bulk it one more time and you come down somewhere in here, and then the next time you break. So you're either breaking here or you'll be breaking a little bit later, a little further down. But in both instances, the move will be strong and robust. And I would first see you getting back up to close to the previous highs. At minimum, you might top out and then rest and pull back a while. And in enough time, if we're talking 1 year, 2 year, 3 year, we're going all-time highs, platinum, silver, and gold again. There's nothing that has changed in the hypothesis. Hyper stagflation will be hyper powerful for gold. And that's what they've ordered up economically for us. A throttling of goods, an increase in the cost of living, and debasement of fiat and debt. Well, when you're debasing the paper, the only thing to own is a physical asset of capital preservation. And they start with gold.
And, even during that time last year or early this year, I think, we even saw that gold to silver ratio get down to, I think, like 45 or something like that, 45 to 1. Is that still in the cards where we'll see that ratio get back down in the 40s? Or I know some people, I think even you had mentioned you see even the 30 level at some point.
We think single digits in the end, which will mean silver will be even higher than our target at 333, our localized high target. We see single digits. At the moment, you're still in that phase where you've had a reversal against a very steep move to the downside.
Platinum, silver, and gold are quietly setting up for multi-year all-time highs, but most investors focus on short-term noise. As Francis Hunt points out here, hyper-stagflation is quietly engineered through throttled goods, rising costs, and fiat debasement, making physical metals the only reliable store of capital. Technical patterns like steep wedges and hammers show resilience after sharp sell-offs, signaling robust upside potential. Even the gold to silver ratio hints at extraordinary opportunities, possibly reaching single digits. Next, Francis Hunt discusses how these metals could outperform paper assets if the macro environment continues to tighten.
It's natural that that happens. You're right about getting into the 40s on the low. We went as low as 43 gold-silver ratio, and now you're sitting at 64, which is quite some rally. As I say, there's probably a third impulse still to happen, which means you might be, but the third impulse is always the smallest and takes the least time. So, the question is, okay, we've had a counter trend move here, and you've got this. You've got what's going on here. What's going to come out of this? You'll either do that and you'll break down, or if we're unlucky and we have a major tech rout and we get into a serious, what I typically call the full financial puke, that would be credit, banks, or, Lehman Brothers type vibes, and tech AI deflation, all of those things, then actually you could go up on the gold-silver ratio. What we want for the gold and silver bull trend resumption is actually a downside break, and we'll have to wait and see if that's going to be delivered to us. So it's not clear yet.
The gold to silver ratio masks the real story behind metal's potential. As Francis Hunt points out here, while the ratio has bounced from 43 to 64, a smaller third impulse could finalize a counter trend before a decisive downside break triggers the next bull wave. Investors often overlook that systemic risks, like a credit collapse or tech deflation, could temporarily distort ratios without derailing long-term trends. Patience and structural observation are key, rather than reacting to headline moves. Next, Francis Hunt shows how the next leg in the metal cycle may unfold if the macro stress plays out.
Gold actually is yours in your hand. You hold it. No one can come and stop me from picking up my ounce of gold. They have to come to my house with a gun. They have to come to my vault with a gun. They have to know where it is. They have to go, it's not plausible. Possession is 9/10 of the law. Have the tool for the times. It's capital preservation times.
All right, Francis, I appreciate that chart because it really does show you the story where if you measure something in dollars, you get one outcome. But if you measure it in gold, it could be completely different. So the right tool for the job is probably gold if that job requires money.
And let me show you something else as an add-on if you're up for it, Patrick, because everyone has been so excited and melt up callers in stocks and all of this. It's not the interesting thing. It wasn't the game. In gold ounces, this is what the NASDAQ is doing. It's in a head and shoulder that is just triggered. Left shoulder, complex head. There's your reversal.
Physical gold is the ultimate hedge against systemic uncertainty, yet few investors fully appreciate its strategic advantage. As Francis Hunt points out here, owning gold eliminates counterparty risk. No digital system or brokerage can confiscate it without extreme measures. Measuring value in gold versus dollars exposes hidden losses from fiat inflation and market illusions. Meanwhile, tech indices like the Nasdaq illustrate volatility and false rallies that often mislead mainstream investors. Next, Francis Hunt discusses how aligning portfolio strategy with tangible assets can reveal the real picture behind paper-based markets.
And by the way, the only time it was dominant and the best thing to be in was then. You had a period from 2012 into 2018, 2020 here where once again tech was stronger. But since the last of 2021, you have gone down, sideways, down, minor rally, down, breaking a new key level. This is all bear market. Since late 21, it's all bear market. And it was also all bear market from 99 till 2012 as well. So it's far more patchy. Even tech stocks, the nirvana for building wealth that everybody has. It's only been from 2012 to the end of 2021, that decade on the reflate. And the only time it super dominated was 99 into the 99 high from then. This is all gold winning, and it is in a reversal, and it wins through those lows as part of this, because this is a turn. It is really significant turn to the downside. But if you look at it in dollar terms, You know, it looks like the best chart you've ever seen because you're not dividing it by anything meaningful.
Headlines exaggerate tech dominance, masking decades of inconsistent performance. As Francis Hunt points out here, the periods of clear tech supremacy were limited, from 1999 highs and the 2012 to 2021 reflation decade, while the broader timeline shows patchy bear markets. Dollar-based charts mislead investors into overestimating tech strength, ignoring real purchasing power shifts. Gold's steady performance through these cycles signals its role as a reliable wealth preserver, quietly outperforming flashy sectors. Next, Francis Hunt shows how understanding these hidden patterns reveals true market leadership beyond misleading narratives.
This is all, a large part of this is dollar debasement. That's how many dollars you need to buy, in truth, your average cost of living, you know. That goes up like that. So if you rebase that horizontally, that chart doesn't look so great anymore. It looks more like this. And that's what everybody's missing. It's not about tech stocks anymore. They're in a reversal. Your gold ounce is your new unit of account. All fiats are compromised. We're in that Ernest Hemingway bankruptcy curve, I tend to call it, which is slowly at first the debasement of money, and then suddenly very, very fast. That's what it does. It's called an inverse parabola. And the irony is, gold, when it is going up, does the exact opposite. I've got a glass in the way of my hand, so that's not the straightest line I've ever drawn. And if you add those two charts together, you get a straight line. Preservation in real terms. But because it's non-linear, by that I mean it's a parabola, what's actually happened is the debasement of the dollar should have done something more linear. It should have gone down like that. But because they lie a little and it's only a little, no one takes note, it doesn't get priced in. What's happening here is all the debasement down to here with overreaction through emotions suddenly has to be caught up. So you get a delayed reaction of catch-up. Again, it's like the 4x4 pulling up a big weight in a trailer with a bungee cord. The trailer hangs back. It doesn't want to debase. If climbing the hill is debasement, the 4x4 is eventually on the top of the hill. There's as much stretch that can be held in the bungee cord, and now it starts springing back. That trailer starts going much faster than the car and comes shooting past.
The dollar's debasement is not gradual. It's a non-linear shock that most investors fail to see until it hits. As Francis Hunt points out here, fiat currencies behave like a bungee cord under extreme stress, initially resisting devaluation before snapping sharply, creating an inverse parabola of loss in purchasing power. Gold, in contrast, offers a steady, real-term preservation, effectively neutralizing the emotional and delayed catch-up effects of fiat debasement. Investors fixated on tech or dollar benchmarks overlook this dynamic, leaving portfolios exposed. Next, Francis Hunt shows how the gold parabola relationship can protect real wealth through sudden fiat shocks.
And that is essentially what's happened. It's a parabola of loss of faith. We have a loss of faith in the American hegemony. Everything points to a loss of trust. Vietnam War, they were caught cheating. They didn't have the gold for the dollars they were printing for the munitions that they were bombing. That's why France sent the ship. They're frauds, they're deceptive, and they're liars. They were caught cheating. Imagine how they've been fraudulent, deceptive, and lying since then, now that the rev limiter of gold that restricted how much they could spend has been removed, and they went free float. You don't even know the beginning of how much has been stolen in this system. So that's it. We're suddenly going to realize huge amounts of fiat debasement. You're going to go, and what was once $10 is now $350. What was once $100 is $2,500. It's going to happen in a space of a few years. It's going to feel surreal, and it's going to crush the average person so badly. And that is stagflation. It is stubbornly high costs, low growth, real wages going down in real terms to a stubbornly high, very high and hot cost of living.
US fiscal history shows fiat vulnerability, and today's trajectory magnifies that risk into a parabola of rapid debasement. As Francis Hunt points out here, decades of policy decisions, from Vietnam-era gold fraud to unrestrained free-floating currencies, have eroded trust, setting the stage for multi-thousand% nominal currency swings in mere years. Investors who ignore this face-crushing stagflation, high costs, low growth, and declining real wages. Understanding this systemic flaw is essential for portfolio preservation and strategic allocation.